Good morning, everyone. Welcome to another installment of the Stablecoin Solutions Show, the first and only show on X dedicated to talking all things stablecoins. While I go ahead and post this on X to try and get some folks into the crowd, I just want to, of course, remind you that if you are not subscribing to my newsletter on Substack, the Stablecoin Strategist, then you are missing the real industry centric and critical information concerning what is happening with the ongoing regulatory development of the Genius Act and stablecoins in the United States. I put out this newsletter to give you up-to-date reports on what's happening in real time with the integration of stablecoins into the banking sector and into the finance sector. And I also offer this as an intelligence report for those in the industry who want to learn what is coming and what the pitfalls are and what the potential regulatory risks are for those who are building in the sector. So take a moment, subscribe to the newsletter. The content is free on the public-facing Substack, the Stablecoin Strategist. And if you missed this live broadcast, as always, this is available on YouTube. This is available to replay on my podcast platforms, Stablecoin Solutions Show on both Apple and Spotify podcasts. So without further ado, we're going to jump into what is really going on this week. And I think it's very important because it is a trend line that we are starting to see with respect to stablecoins. In 3 days, we've seen 3 separate set of incumbents basically signal exactly where they stand on stablecoins. And I think it's a fascinating glimpse into where the sector is going and just how disruptive fully regulated stablecoins are going to be. For those who are tracking all of this, reminder that the Genius Act's FinCEN Treasury regulatory proposed regs are in an open comment period, which expires on June 9th, I believe. So if you want to get any comments in on that, be sure to get those in as soon as possible. If you have any thoughts on stablecoin regulation and what the FinCEN Treasury side of those regulations are going to look like, that comment period is closing. Now, back to what I think is happening in the broader sector. Like I said, we have 3 different incumbent sectors in the money movement sector that are all simultaneously this week making big announcements as far as how they are going to address stablecoins. And I'm going to touch with what I published today on the Stablecoin Strategist, which is the first of 3 articles that I want to talk about on today's show. And this is an article that I put out today talking about an announcement that has come from the major big banks in the country. America's 3 biggest banks, and there's no surprise here who they are, JP Morgan, Citi, and Bank of America, among those, have announced plans to build a shared tokenized deposit network that's going to come out in the first half of 2027. For those who've been watching closely the debate between the banking sector, Congress, and the crypto sector over this argument on whether stablecoins should allow consumers to earn yield or rewards or whatever word you want to put on it, there's been this really aggressive front by the big banks, presumably in defense of the community banks, that they want to protect those community banks against depositor flight. They don't want depositor money leaving the banking ecosystem and going into stablecoins because they're afraid they're going to then lose the money that they put on the street and loan out and earn interest on. As a reminder, they pay out very little in interest to depositors, but they pay out and they earn substantial interest on taking your deposits and then putting them out on the street and loaning against them. So I think the first thing we need to cover in this article is that this really tips the hand of what the big banks have really been planning to do all along when it comes to stablecoins. And that is pretty clear at this point. They are not interested in integrating stablecoins in the purest sense into their banking services. That's been my thesis for a long time. That's been my opinion. I think a lot of this talk about what they want to accomplish in the Clarity Act as far as limiting rewards on stablecoin because of this fear of deposit flight, it has really been a very orchestrated attack on pure stablecoins because they want to protect their moat. So the ultimate thesis of the piece that I wrote today and put out on the Stablecoin Strategist on Substack is simple. The banks are not, and I mean the big banks are not building a bridge here as they would characterize it with these depository tokens. They are essentially fortifying a moat around the monopoly that they already have when it comes to controlling consumer money. It's probably worthwhile talking about exactly what we have here when it comes to the difference between a stablecoin and a depository token. The depository token is simply a digital representation of what's already sitting in bank accounts. Yes, it integrates some degree of blockchain technology, but it is a closed ecosystem where these depository tokens don't move like pure stablecoins, which are more decentralized in the sense that you can self-custody your digital dollars. You can move your digital dollars in and out of the banking system with fully regulated stablecoins. Under the depository token framework that these banks are proposing to build, which they call a bridge, I call it a moat, is basically a blockchain wrapper around existing bank deposits, and it operates intrabank. So JP Morgan's already done this with their JPM token. They already have an intrabank depository token. Now what they're talking about is the big banks are circling the wagons, and they want to basically do a consortium of depository tokens that will run inside banks. While this is probably good for commercial clients and institutions who want to do, interesting things with treasury assets and so forth, it doesn't help the consumer in any way. It is in no way an innovation that I think is going to benefit the consumer. And to suggest that this is somehow an innovation that's good for the consumer is obviously totally missing the point here. So at the end of the day, it confirms my initial thesis that I have been talking about all day long to anyone who will listen, that the banks really are here to stop stablecoins in every meaningful sense and to offer the consumer what they want to describe as an innovation in blockchain technology, but it's really just the same old depository token structure on a blockchain wrapper. So that is the first interesting piece that I had covered. Second interesting piece that I want to talk about that went down this week is an announcement from the big credit card companies. Now we have the second component of the sector players pivoting aggressively in a way to prepare for what's coming with stablecoins. And in this particular piece, the toll booth operators, MasterCard and Visa and Stripe, which is the intermediary, have announced that they are going to be launching their own stablecoin token. Interesting. So, as I've previously talked about, Visa, MasterCard, Stripe operate a toll booth economy where for the privilege of being able to accept credit card payments, the consumer pays at the point of sale with a credit card. The merchant has to run that transaction through MasterCard or Visa or through Stripe as an intermediary to process the payment. The payment comes with a 2.5 to 3.5% merchant fee that the merchant has to absorb for the luxury of using the credit card rail. The merchant's money sits in a float waiting to be dispersed to the merchant, so they don't get their money instantly. And that's why I've always been advocating for stablecoins as the solution to that. So in this other piece that I put out where I talk about the fact that the toll booth economy is changing, that the major credit card players are now launching their own stablecoin, it shows you that they understand the existential threat that they are presented with at the point of sale when it comes to consumers and options. Because if the consumer under the Genius Act with fully regulated stablecoins can directly pay the merchant with stablecoins from their wallet going into the merchant's wallet, that eliminates the need for the credit card companies. That eliminates the need for Stripe as the intermediary. And that mainlines your digital dollars from your wallet directly to the merchant. You avoid a 3.5% merchant fee that the credit card companies currently extract. You eliminate the delay on getting your money into your account, which means you don't have to wait to cover your bills as a business. You're getting your money immediately. Well, faced with this really disruptive innovation, the banks are now going to be launching their own stablecoin. And in the report that was released by CoinDesk, And again, you can read this article at the Stablecoin Strategist on my Substack account. They talk about the fact that Coinbase may even have some interest in it, which presents an interesting thing because what this joint effort to launch a stablecoin on behalf of Visa, MasterCard, and Stripe, as reported by CoinDesk, what this is going to enable is, and it's pretty clear from the reporting, it's direct competition with Circle and with Tether, who both dominate when it comes to the stablecoin market. So rather than integrate Circle and USDT Tether, or the USDAT equivalent Tether that's going to be coming out on the Genius Act, rather than in implementing those as the credit card processing stablecoin, the sector is launching their own standalone stablecoin. The fact that this report from CoinDesk suggests that Coinbase has some interest in potentially joining this consortium over this unified stablecoin for credit card transactions suggests that the upcoming renewal of Circle's arrangement with Coinbase may have some new negotiating leverage. Because as I've previously discussed, the reason Coinbase has been fighting so vehemently on behalf of trying to retain rewards over stablecoins in the Clarity Act is because they have a relationship with Circle, a business relationship, where Circle pays Coinbase handsomely, and Coinbase gets to pay rewards to anyone who passively holds their stablecoins on Coinbase, specifically USDC. And they do have a fee arrangement with respect to that yield. However, that agreement is coming up for renewal in August. The fact that this report, if it is true, and again, it's not a press release, this is strictly a report, but if it is true that Coinbase is actually contemplating joining MasterCard, Visa, and Stripe in this new stablecoin launch, which is supposed to be an alternative to USDC from Circle and Tether's USDT, well, this presents an interesting issue for that renewal of that arrangement. So again, that's why I provide this industry level reporting on what is going on in the stablecoin sector, because in my experience, in having obviously handled a lot of work as a lawyer and a lot of work as a cryptocurrency lawyer, I see around corners and I see these things. And what I've got my eye on right now is where that renewal of that arrangement between Circle and Coinbase is going to go. Because now I think Coinbase, if they are truly intending to explore this alternate stablecoin, well, that could certainly add some leverage in the negotiation process with Circle. So I'm keeping my eye on that. But the broader conversation is this. The incumbents understand that stablecoins are coming. They're not going away, because remember, even if the Clarity Act, which some think is on life support at this point, there's been a lot of ambitious talk from senators that they can get it done by July 4th, but that is looking more like August. The closer we creep into the fall with this, the closer we get into the midterms. If this thing doesn't get done over the summer, then if power flips, as I've previously talked about, in the midterm elections, if Elizabeth Warren gets the gavel on the Senate Banking Committee, if there is a flip in House and Senate seats, then the likelihood of this meaningful crypto legislation getting done is probably very remote. So there's a real urgency to get this. But remember, regardless of what happens with the Clarity Act, the Genius Act is law. Stablecoin Circle arrangement currently exists under what's baked into the Genius Act. So if the Clarity Act doesn't get over the goal line, there is an opening for rewards to still be available over stablecoins for USDC on Coinbase. And this also doesn't do anything to disrupt the regulatory rollout of stablecoins under the Genius Act, which is coming this summer and should be finalized by 2027. Once this stuff goes live, all the regulations go into effect. Now we go from compliance to enforcement. And that's where anyone who's building in this sector needs to understand and read intelligence reports like I try to provide in the Stablecoin Strategist to understand the risks that exist around the corner in these proposed regulations and what the enforcement consequences are for getting it wrong. So the credit card companies, going back to the broader conversation, they understand this threat that's coming with stablecoins. They understand that if the point of sale now turns from tap your credit card to tap your phone, which is connected to your digital wallet, which has stable coins in it that you can send directly to the merchant when you make your purchase, that's a threat to their model. So rather than completely absorb that threat and move on and continue to stay with their traditional way of processing credit card transactions, they're pivoting to their own stablecoin, as has been reported. Now, this actually ties in with an interesting announcement yesterday from Cash App, which I can't ignore because it is pretty funny. Cash App announced the Cash App Wand. And if you haven't seen it, I put out a video on my X account and on my TikTok talking about what this innovation is. It might seem like a gimmick, but I think it is a very clever marketing strategy because it merges fashion, functionality, and fun at the point of sale. It's basically a magic wand, which is a piece of swag. It's a piece of accessory that you could put on your keychain, you could put on your belt, you could put on your purse. And you can use this once it's enabled to tap when you make purchases. So when you go buy that cup of coffee, instead of using your boring debit card to process the payment, or instead of tapping your phone, with this Cash App Wand, magically, you can tap it and pay. While this seems like a gimmick, remember that 1 in 5 teens in the United States have Cash App already in their phone. If this kind of accessory, which has, by my understanding, sold out already, $25 cost, got to go to Cash App to claim it, it's already sold out. If this really catches on and people want to use this kind of flair when they make purchases, well, this is a, number one, brilliant marketing strategy by the folks at Cash App, including Jack, who is the founder. And this now enables interesting new payment solutions, including stablecoin payment solutions. And the credit card companies have now further competition. So I can totally understand why they made this decision to want to consider launching their own stablecoin. As always, I want to look under the hood and I'll continue to watch this. I want to see what that's going to look like, what the fees are going to look like for doing this, so that I can get a better understanding of whether this is going to be a true stablecoin. You can see the thread going through this conversation. It always boils down to, every time these legacy players make these announcements about what they plan to do with stablecoins, my question always is the same. What are the fees going to look like? Because I know what the fees are for pure stablecoin movement. They're near pennies and they move money instantly, faster than the banks can currently move it. So I always want to know what the fees look like whenever we talk about this stuff. Now, the other piece, the other third interesting movement that's happened is another piece that I published in the Stablecoin Strategist on Substack. I entitled it Show Me the Fees. This one has to do with MoneyGram and MoneyGram's announcement that they are also launching a stablecoin. Do you see the trend here? We've got the banks launching, quote, stablecoins, depository tokens. We've got the credit card companies, MasterCard and Visa, the biggest players, and Stripe, talk about them launching a stablecoin. And now we have the money remittance sector launching a stablecoin. So that article is interesting to me because what I'm seeing there is I'm seeing another legacy player, MoneyGram, and I've previously written about Western Union and their announcement about launching a stablecoin. And now you've got the legacy player, Western Union, jumping into the fray as well. And they are building a stablecoin for money remittance. That's great. Love it. Of course, what's missing again from the press release, and it's the MGUSD token. It's a US dollar stablecoin, which they're calling the connective tissue of its global network. For those who don't understand money remittance, and I've described it as a poverty tax because most of the people that end up using money remittance services like MoneyGram, Western Union, etc., they pay a steep premium to move money, sometimes as much as 6%. And that is for people who don't have traditional banking access, for people who are either migrant workers living and trying to send money abroad to their families, or people that are living here in the United States who have family members overseas in other countries where they don't have easy access to dollars. They rely on things like these money remittance services, which charge a poverty tax, a high fee to move money. These particular money remittance services are basically charging this toll booth to take your money, send it to someone overseas who has to then go to a brick and mortar, usually, and pick up their money. This is being disrupted by stablecoins because think about it. Why would you pay 5-6% to a money remittance service like Western Union or MoneyGram to send money back home to your loved ones who desperately need it when you can do it with stablecoins? You can do it for pennies and it moves instantly. So now, again, another legacy player who is threatened by stablecoins is announcing a stablecoin. Can you see the trend here, folks? So in this particular pivot, the interesting things that I'm looking at, and again, if you want to check out the full article, Stablecoin Strategist on my Substack, it's free. What they're doing here is they are going to pivot and integrate the stablecoin as the money movement mechanism. But again, what they've left out of the press release, which is a recurring theme that I keep seeing, what do the fees look like for this? Because if it's truly a stablecoin, then the fees should be near zero to move customer money. Now, this puts these legacy players like Western Union and MoneyGram in an interesting dilemma, because if they're truly launching a stablecoin that offers zero fees to move money or near zero fees to move money instantly, that's going to put tremendous pressure on their bottom line. Because as is also reported in their press release, they have over 500,000 brick and mortar physical locations globally. How in the world are they going to support that bloated system of brick and mortar locations if they lose this fee extraction model, this poverty tax that I talk about on taxing people who desperately need to send money overseas and need to rely on these money remittance plans? So the only other way that they can do it, and again, this is kind of my strategist look at this. This is kind of my whole purpose for writing the newsletter and for doing this particular podcast, is that I look around the corner and I try to look at how is this going to impact the builders in the space? How does this impact the consumers in the space? So these intelligence reports that I put out sort of break it down. So while I don't know because it's not clear from the release, one thing I'm speculating about is, are they going to make up the lost revenue on charging the consumer 5, 6, whatever percent to send money overseas? Now that they are going with a stable coin, if it's a true zero or near zero stable coin, they got to make up the money somewhere. Now, as an issuer of a stable coin under the Genius Act, as the issuer, they need to back every stable coin they create under the Genius Act with a treasury equivalent asset. The business model is simple. Circle's been doing it for a long time, Tether as well. Whenever you create these reserve assets, you can earn interest on those reserve assets. So as a stablecoin issuer, MoneyGram, through this arrangement that they've put together, they do have the opening to earn yield on the treasuries that they hold that back up the stablecoins. So that seems like maybe the revenue model that they're looking at, that they're exploring. However, there's a little bit of friction baked into this that I've been thinking about because, like I said, the person who uses MoneyGram or uses these other money transmitters like Western Union, they're not people that are keeping, generally, they're not people that are using the banks as a way to custody, or they've got money market funds where they're keeping their money and earning yield on their money and they want to keep their money passive. This is usually people who get a paycheck, who deposit their paycheck, who then take out money to send back home to someone who desperately needs that cash immediately, like mom who's living overseas. And they send it, they pay their fee. The money goes to the brick and mortar location where mom can pick it up in the foreign country and immediately converts it into their currency because they need it to exist. So there's not the float. These stable coins are moving quickly and being liquidated into fiat currency quickly. So they're not being parked for a long duration in float. So this presents another stressor on the revenue model. So what I'm curious about in this pivot that MoneyGram has announced, if they're going to be a true stable coin, which is going to be paying near zero fees to move money, if they're going to rely on float on the treasuries that they have to custody for every stable coin that they create, how are they going to continue to sustain 500,000 physical locations throughout the country? I'm curious to see. I'd love to see more answers because I have obviously more questions than answers, which is why I titled the Substack piece, Show Me the Fees, because I'm curious to know what those fees look like. So that is where we're at when it comes to stable coins for this week. Again, the FinCEN Treasury comment period on the proposed regulations, which apply to the Bank Secrecy Act components of it, the anti-money laundering components of stablecoin issuers, and the know your customer components. These are all very significant regulations that are being proposed with serious consequences on the enforcement side if the sector players get it wrong, which is why, again, I write the Stablecoin Strategist on Substack for that very reason, to sort of point out where these landmines exist when we flip that switch and the regulations go live. Again, that's when the enforcement regime goes live as well. So getting it wrong has consequences. So the deadline to comment on that is coming up next week. I believe it is June 9th. Check the Treasury and check FinCEN's website for how you can make a comment. I will be writing one and sending it in, and I'll certainly make that public as soon as I do. Also, we had these three major developments, all basically playing into one overriding theme. The big institutional players, the credit card companies, the banks, and the money remittance service providers are all waking up to the reality that they either adapt to stablecoins or they're going to get disintermediated and disrupted. Because in closing for today's show, the entire reason that stablecoins present a threat to these legacy institutions is because they empower consumers to move money faster and cheaper than ever before, which is the entire premise of the book that I wrote, the free guide, Make Your Wallet Your Bank. If you want to download a free copy of that, go to any of my profiles on any of my socials and you'll get that link. But this free guide talks about how you can break away from the legacy fee extraction model, the credit card fee extraction model, the bank fee extraction model, and the money transmitter fee extraction model, and adapt stablecoins into your money movement behaviors. You can take control by making your wallet your bank, and you can bypass these intermediaries and move your money cheaper and faster than ever before. So that being said, that is the existential threat that exists right now for all these legacy players. And in 1 week alone, on the eve of the Clarity Act getting teed up for a Senate vote, hopefully, you are seeing the three biggest players, the three biggest incumbents, the big banks, the big credit card providers, and the big money transmitters, the big money remittance services, all pivot in one way, shape, or form to stablecoins because they know that the threat is real. And if this happens, if this disruption is what I think it's going to be, it's going to drive these legacy players to have to reduce their fees to near zero. If they have to reduce their fees to near zero, they're going to have to come up with new and innovative ways to stay relevant and be competitive. Okay, that's enough for this show. Thank you to everyone who joined. Again, if you missed the live broadcast of the Stablecoin Solutions Show, the podcast will be available on Spotify, on Apple. You can catch it on YouTube. I've even added LinkedIn for today's live broadcast. So there's plenty of ways to find me. Again, if you need more about me, stablecoinsolutions.io is my main website. You can find all my social links there. You can subscribe to the Stablecoin Strategist. If you're an industry player and you want intelligence reports that give you the breaking news of what's happening in the sector and how you can get tripped up on the enforcement side of this, then you should definitely consider subscribing to the Stablecoin Strategist on Substack. Okay, thank you to everyone who joined. I hope you have a wonderful weekend. I will be back next week. We run this show live every Friday, 9 a.m. Eastern. The Stablecoin Solutions Show. Make it a part of your daily routine. Thanks, everyone, for joining the conversation, and have a great weekend.